Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. The Canadian economy added 53,600 jobs in November, exceeding economists' estimates and also marking a third straight month of job gains. The new jobs were concentrated, though, in the part-time sector and the private sector, led by employment among young people, 15 to 24. That group has been facing, of course, some difficulties getting into the market. The unemployment rate fell to 6.5%, the lowest since 2024. Stellantis has received a default notice from the federal government for moving production of its Jeep Compass SUV to the U.S. Industry Minister Melanie Joly says the automaker is in default on its taxpayer-backed financial aid. Governments in Canada have pledged more than $500 million to Stellantis to cover costs in its two assembly plants in the country. Joly has been in a dispute resolution process with Stellantis to bring production back to the Brampton plant. Shares of Ulta Beauty are surging today, up 14.5% right now. The cosmetics retail company reported better than expected results in its latest quarter, with profit and sales surpassing Wall Street estimates. The results were driven by strong demand for fragrance and skincare products. Ulta also boosted its full-year sales and profit forecasts and logged growth across all major categories. And taking a look at the markets, that rally is back on again for the TSX now into its third day. It's up ever so slightly right now. It was up higher earlier, but up by 0.03%, almost a wash, but still in the green. We'll take it. And taking a look south of the border, things are all in the green there. You can see the S&P up by 0.3. Similar situation for the Dow, and the NASDAQ again, 0.35% right now. So all having another good day to end the week and to start the month. Well, we're just a few weeks shy of the new year, and our next guest thinks 2026 will be a year in which investors will perform well in sectors like utilities, industrials, and real estate. Let's get more on this from Brett Ewing. He is a senior financial advisor and chief market strategist at First Franklin Financial Services. And Brett, thanks as always for joining us.
Yes, thanks for having me, Roger.
Okay, what I'm not seeing there, and what everybody, of course, is talking about, AI. Your thoughts on that? Why are you looking at those other areas? But let's get your thoughts on why you're not too sure about AI.
Yeah, so we just to clear the air, we do like AI. We will stay invested in 2026, but I do feel some of the sheen has been washed off of the AI trade here. I think it's a healthy correction that we've seen in AI. You know, whether it, the clarity on the debt situation, the clarity on the special purpose vehicles and the depreciation issues. These are all good things to get out there, and the transparency of it. Having said that, I do believe there's other areas of the market, interest sensitive areas, that I think are going to outperform on a relative basis. I think the honeymoon is kind of over in that trade on a relative basis. AI has dominated the field over the last 24 months, but there's other areas of the market that are ready to roll.
Okay, and you're not seeing AI go anywhere. And let's talk about you're looking one defensive and two cyclicals. Let's start with utilities. What are you liking about utilities?
I mean, the power demands that are forecasted in this country are record. I mean, it's an amazing amount of energy that we're going to need in order to put all of this AI computing to work. And we just feel utilities are in a great place to expand their operations, and they're doing that actively. And we believe that's a good area. Also, they're very interest rate sensitive, so rates should be coming down. Our forecast for rates next year is a little bit more aggressive than what the market is pricing in. We believe there's going to be over 4 cuts next year.
And with the utilities, any concerns? I mean, AI is tied into it. Any kind of correction in AI, would that have a spillover into the utilities at all, do you think?
Well, we're seeing the infrastructure forecasted to continue in the AI trade, and we believe the utilities, these are long-term projects. They're just being implemented over the last couple of years, and we see a pipeline of that for the next 3 to 5 years.
And moving, taking a look now, the Fed, there's been talk we're going to see a cut. Will we see more after that, do you think?
I do. Our forecast right now is a cut in December, and we believe there will be at minimum 4 cuts in 2026.
And why so aggressive on that? What makes you think that?
I mean, we just had our inflation report come out here this morning. I mean, I looked at one of the largest components in the inflation report. You know, it's a shelter, right? And, you know, if you look at the month over month change, it is 0.01. And we believe that that component is going to continue to cool. Across the board, by the way, we've seen cooling in inflation. We think that trend is intact.
And it's still running, though, it's been running about 3% for how long now? Probably, is it closing in on a year and a half, 2 years? We're running around 3%. They've been trying to knock it down. Where do you think it's heading?
I think it's headed south, Roger. I really do. I mean, every leading indicator that I'm looking at with our research team, we do not see inflation being a problem next year. We believe AI increases productivity. Our call is productivity actually increases quite a bit in 2026 as very deflationary pressure, even with growth. So we're in the low inflation camp for 2026.
Okay, and one last note: everybody likes to talk about all the Mag 7 and AI, but you're also looking at some small caps that you're seeing some opportunities.
I do. If you buy into what I'm saying about inflation, if you're buying into what I'm saying about the interest rate cuts, we love interest-sensitive areas of the market, and I can't think of a better one than small and mid-cap companies as an asset class. And Roger, we've already seen this trend. It's happening already, and people aren't really talking about it enough. The S&P 500 bottomed on April 9th. Since that bottom, we have rallied tremendously in the S&P 500. But guess what's beaten the S&P 500 as of we're sitting here today? The Russell 2000. The Russell 2000 is outperforming the S&P 500 so far, coming out of that big correction that we had back in April. And we think that trend's intact and will keep running. The breadth of the market, our call here is that it expands throughout 2026.
And what's giving you that confidence?
I think lower rates is helping. I think the tax bill's out of the way. The tariff conversation is a fade. And I believe we have good policies right now that are pro-business with deregulation, and it's game on. I mean, I think everyone has incentive to start doing some CapEx investing as we move through 2026.
And with the tariff, I mean, the tariffs are everything up here. What gives you that thing? What makes it look? Let me try that again in English. It's one of those days. It's Friday. what with tariffs? Have people adjusted to it? Have businesses adjusted to it? Do you think? And they're absorbing it, and it's working. They can handle it.
I think so. I think that it's worked itself through the system. I think by the first quarter, we've had a lot of data that hasn't been coming out due to this government shutdown. But I do think by the first quarter, we're going to have a lot more clarity on the effects of the tariffs, and it's going to be, you'll be able to quantify it quite a bit more on how it's affecting. But right now, we believe, listening to earnings calls and listening to retailers out there, we believe it's filtered through the system.
Okay. On that note, Brett, we'll wrap it up. Thanks for joining us.
Thanks for having me, Roger. Have a good one.
You too. Brett Ewing is Senior Financial Advisor and Chief Market Strategist at First Franklin Financial Services. Well, shares of Ulta Beauty are soaring today after the company boosted its full-year outlook and posted better than expected third-quarter results. We'll get more on that after this. Well, shares of Ulta Beauty are trading higher after the Illinois-based cosmetic and fragrance company boosted its full-year profit forecast and logged a beat for the third quarter, convincing beat. Let's get more now from Susan Anderson, Managing Director at Canaccord Genuity. Susan, thanks for joining us as always. Let's talk about which numbers did you like the most? Because there are quite a few now. I was looking through some of them, a lot of numbers to like there.
Yeah, really the numbers were strong across the board. They reported comps up 6.3%. The street was at 3.5%. So a very nice beat there. Even in the stores, the comps were up mid-single digits, which we haven't seen in a while. E-com sales were up mid-teen, so they were gaining share across both of those channels. And then they beat the bottom line as well, driven by a very strong gross margin as well as the sales. Earnings came in at $5.14, beating the street at $4.61. So really strong numbers across the board.
And what did they do? I mean, I think there's been a lot of concern in retail about numbers, but this kind of is smashing things. What are they doing right there?
Yeah, so, beauty, once again, is continued to be, very strong. So, that's helpful to them. But also, I think the things that they're working on with their Beauty Unleashed strategy is starting to work. They're bringing in newness and innovation. They're improving merchandising and marketing, improving customer service. And I think all of that's finally coming together. They started to expand internationally. They bought Space NK a while back, which is based in the UK. And then also they're opening up stores in Mexico, and they're doing some franchise stores in the Middle East. So I think all of these things are coming together and adding to the really strong numbers. I would note, though, too, that they did talk about some price increases, more so in third quarter versus second quarter. Typically it is normal course of business, but I think they're seeing a little bit more because of the tariff situation. Mm-hmm. And so I think that did help the top line as well.
And who's their audience, or who's their customer, I should say, not their audience, but who's their customer? And where are they on the K?
Yeah, so, I would say across really all demographics. So the good thing with Ulta is they cater to prestige and value products. So, about half their business is prestige, half is mass cosmetics and beauty products. So, really they cater across all price points, which I think really benefits Ulta. They did talk about consumers still really looking for value. And it sounds like they saw that even more so in the recent quarter. So, the fact that consumers can trade across price points really across the store, I think is really helping them. But, really, I think all ages are shopping in their stores. Still more majority women than men, but men are also shopping in Ulta as well.
And were there any weak points in those sectors at all that you saw?
So, they did deleverage on SG&A, really due to higher incentive comp because results have been so strong, and then some deleverage of some other expenses and some investment. So that was the one area that was not as strong, but, I think that the top line and the strong gross margin really made up for that.
And with their international expansion, how is that performing? How's that doing?
Yeah, it's doing well. They don't break it out, but they talked about some learnings already that they're getting from Space NK, which, they're thinking about potentially rolling out across the other, the Ulta store fleet. So I think, longer term, it's another growth vehicle for them, which I think, is partly why the stock has done so well.
And is this is this their big season, or is beauty products something that kind of goes throughout the year, or are we looking for some numbers that we want to see a nice increase over from Black Friday into the Christmas season?
Yeah, definitely holiday is a seasonal category for beauty, maybe not as much as some other categories, because sales are still pretty strong throughout the year, but you definitely see a bump up over the holiday season. They did talk about Black Friday being very good and strong so far. So, that was positive. However, they did mention that there's still a lot of shopping ahead. So we'll see what happens. Typically, we do see a December lull. So, we'll see how much that eats away at the strong performance over Black Friday. But in general, just our checks as well in the beauty category, it continued to be very strong, and promotions very rational over the Black Friday season, which I think is encouraging heading into the rest of the holiday.
And they raised their outlook. Where do you see the growth coming from?
Yeah, so they raised their outlook, which we think still could be conservative because it implies kind of a step down in comps to low single digits for the fourth quarter. I think they're being conservative potentially if the strength continues throughout the rest of the holiday season. I think, they could do another mid-single digit comp again, but, we're watching to see what happens. But they also raised the bottom line as well. So, I think that strength is they saw positive growth in all of their four categories this past quarter. So I think that'll continue into the fourth quarter as well.
And just this is more out of curiosity for me. They're expanding. Any talk of coming to Canada?
So, before COVID, they were going to expand into Canada. And then when COVID hit, they decided not to. So I would think that that's definitely on the radar for future expansion.
Okay, we'll leave it there. Susan, thanks as always for joining us.
Thank you.
Susan Anderson is Managing Director at Canaccord Genuity. Well, Netflix will acquire Warner Brothers Discovery for $72 billion US. We'll get more on that after the break. Netflix has agreed to buy Warner Brothers Discovery's TV and film studios and streaming division for $72 billion US in an acquisition that is expected to close in 12 to 18 months. Let's get more on this from Jason Bazinet, Senior Analyst of Internet and Media at Citi Research. Jason, thanks very much for joining us.
Yeah, absolutely.
Your thoughts on this deal? I mean, there was been talk. We had other groups involved in this. All of a sudden this morning, it's like we think this is the one they're going to deal with, and then all of a sudden we have the deal. Who wins on this?
Well, this was a super surprising outcome from our perspective. The way we had framed this is there are three subscale streaming apps that exist globally: Paramount, Max, and then of course you have Peacock. And we thought one of those three would, sort of merge with Warner. One of those two would merge with Warner Brothers to take on Netflix as the champion. We only put a 5% likelihood that Netflix would emerge as a bidder because it's not a must-have asset for Netflix. It's a nice-to-have. What is Netflix really interested in? We think it's really about the intellectual property that sits inside Warner Brothers is going to help them. And I think that's the real strategic asset that Netflix wants.
And did they pay a good price for it, does it feel?
Well, the reason we put a 5% likelihood is the purchase price that's being bandied about is a very expensive way to get intellectual property. And so, the company has said that they don't think this deal will be accretive until 2 years after it closes. So that's, 3.5 years from now. And so the market is going to have to sort of stomach through some level of earnings dilution for sort of the long-term promise of leveraging Warner Brothers intellectual property.
And will this deal have any trouble getting approved? Is this too big of? Is this almost a monopoly now for Netflix? Can we?
Well, it's interesting. I mean, if this reminds me a little bit of the last time Warner Brothers was put up for sale. At the time, the first Trump administration raised, a lot of cane about it and said, oh, they're going to fight it in the courts. When you went through the sort of traditional sort of market share concentration metrics under that former deal, it really made no sense that the regulators would block it, but they tried to block it and they slowed things down in court. Ultimately, AT&T prevailed. They were able to acquire Warner Brothers. We think the same setup is true here, which is it feels strange because it's the biggest, streamer, Netflix, buying an attacker. But if you go through the math, either at the studio level or in terms of streaming subs, I think the government's going to have a hard time blocking this deal.
And can you see anybody trying to fight it? Any of the other companies that were involved in potential deals here?
Well, yeah. I mean, we I would say that, it's so important. And, you can look at how Paramount stock is trading today. It's trading down a lot on this because it really sort of, without getting requisite scale in the streaming business, it really puts them in a bad position. I think, Paramount probably knows that. And there have been press reports that say that Paramount has a plan B, which has suggested that they may appeal directly to Warner Brothers shareholders to try and block this deal. And we'll see, if Warner Brothers shareholders, will take the Paramount offer or if they'll take the offer that was offered by Netflix.
So we could actually see Warner Brothers investors saying no to this then.
Well, I don't know. I haven't spoken to enough Warner Brothers shareholders to know how they'll vote, but I would just say that the press has certainly alluded to the fact that this may not be done if Paramount has decided that it's not done fighting for this asset.
And so, what happens with Warner Brothers? Where do you see it being taken if this does go through and Netflix takes control? Where do you see them leaving it alone and using? And like they said, they just want their intellectual property.
Well, that's certainly what they've said. I mean, it's a little bit strange, right? Because when I think of Netflix, when they produce a piece of content, they don't license it out to anybody else. Of course, Warner Brothers, when they produce a piece of content, sometimes they put it on their own app, sometimes they license it to other streamers, including Netflix. And so you're talking about a very unorthodox situation here, where if you take Netflix at their word, if it's something that's produced out of the Netflix lot, that would not get licensed to a third party. But if it's something that gets produced out of the Warner Brothers lot, they're going to run it down the normal theatrical window. They might license it to third parties. That's how they're describing it, but it's pretty unorthodox.
And so for now, I think that it sounds like they might just let it sit. But I think they're going to have to figure out what to do with it. What about what didn't get so I'm trying to remember what went to Warner Brothers or what went to Netflix and what was left. What will happen with that part? I'm trying to find where the
no, that's right. So just to roll the clock back, Warner Brothers originally announced that it was going to split itself into two pieces. And on one side would be the studio and the streaming app, which is what Netflix bought. The other piece are the linear cable channels that are tied to the pay TV ecosystem.
Yes.
These are channels like TBS, TNT, CNN. Those are going to get spun out. So if you're a Warner Brothers shareholder, you're getting mostly cash from Netflix for the streaming and studio, and then you're going to get a separately spun entity that's going to trade publicly in the third quarter of next year.
And will there be interest in that, or is that considerably weakened now, the ones that are left?
Well, I think in general, the street doesn't have any interest in linear cable channels. No one really wants to buy them. It's part of the reason that I think Warner Brothers originally decided to split it in two. It was essentially taking the bad part of Warner Brothers and hiving it off and just sort of keeping the good part that has strategic value to suitors and separating those. So I don't think the strategics have much interest in linear cable nets. The buy side doesn't have much interest in linear cable nets. And so it's just sort of an orphan asset, and the trajectory of that business will just be a function of how rapidly households continue to cut the cord and migrate to these streaming services.
All right, so still lots to unfold with this. Jason, thanks very much for joining us.
Absolutely. Thanks for the time.
Jason Bazinet is an internet and media senior analyst at Citi Research. Well, despite the 50% aluminum tariffs that have been imposed for almost a half a year now, my next guest believes the U.S. is still a very good market for Canada's aluminum exportation. We'll be back with more on that next. The Canadian labour market added far more jobs than expected last month. Data from StatsCan shows 53,600 jobs were added to the economy in November. Economists were expecting a drop of more than 2,000. The increase was driven by part-time work with healthcare and social assistance leading the gains. The unemployment rate fell to 6.5%, the lowest since July of 2024. Laurentian Bank of Canada reporting revenue for its latest quarter that came in below Bay Street expectations. Profit also fell 16% due to lower income and softer revenue in other segments. The bank also set aside more money than expected for potentially bad loans. The results follow an announcement from Laurentian earlier this week that National Bank is acquiring its retail and small businesses, while Fairstone will acquire Laurentian in total for $1.9 billion. West Fraser Timber says it will indefinitely curtail its oriented strand board mill in High Level, Alberta, effective next spring. The forestry company says the move is due to a significant weakening of demand. Nearly 200 employees will be affected. West Fraser also says the idling of one production line at its Georgia facility will continue indefinitely. And looking at the markets right now, the TSX was in the green now, solidly in the red, down about 0.3%, and south of the border. How's the rally? There was a good little rally going on there. Let's see if it's holding. So yeah, it's still on the plus side. S&P 500, Dow, and the NASDAQ all up 0.1 to 0.2%. Well, since U.S. President Donald Trump raised the aluminum tariffs to 50% in June, Canada has been shifting its aluminum exports to other parts of the world. My next guest says this high-level tariff on aluminum is simply not sustainable. And let's bring in Jean Simard, the president and CEO of the Aluminum Association of Canada. Jean, thank you very much for joining us.
My pleasure. Thanks for inviting me.
You think this shift to Europe and other places isn't something that's going to continue?
Well, the situation with a 50% tariff is highly disruptive for an integrated value chain, industrial value chain like we have in North America, across Canada and US. The access to the European market has always been there in the past, but since we're a truly integrated market in North America, the first place where metal wants to go because of market attraction is the US. So we had to revert to ship to Europe temporarily over the summer because the transactional price for aluminium was not factoring in the total cost of the tariff. It took some weeks, and finally, it has reached a threshold where metal is attracted back into North America, which means that more and more through the coming weeks and months, the end user, the consumer, will be hit by the full impact of the tariff, which will become more and more unsustainable, disruptive, and potentially create some inflationary pushback in the U.S.
And so now, sorry, just to clarify, the price to sell to you, the U.S. is more appealing right now than Europe?
Well, it's gone back to a situation where the tariff impact on our shipments to the U.S. are, I would say, neutral, whereas over the early month of June and then into July, the price was not factoring in the total cost of the tariff. So we were basically losing money shipping to the U.S. We lost about $600 million over a matter of weeks, which brought Canada, the Canadian producers, to ship or to avoid shipping about 45% of the metal that normally goes to the US, keeping some in Canada and shipping some to Europe. So it was a matter of avoiding losses. And the best way to do that was to ship to Europe, which offered a better or less disadvantageous position. So now that the market is paying or factoring in the full cost of the tariff, the situation for us to ship to the US is not as impactful as it was before that.
Now, are you still shipping similar numbers then, or will you start shipping similar numbers to what you did before then?
We're getting back there, yes.
And which is, I guess, is good news for your group, but it's the consumers and everybody else is paying the price. So where does that leave you? Where does that leave Canada when it comes to the U.S.? You still want to see, obviously, the tariffs eliminated.
Yeah, logistically, the U.S. market makes far more sense for us than any other market, although since our smelters are seaborne for the most part, we have the option of shipping, as we've done over the summer, to other markets. But as much as we can, this is a market in which we've invested ourselves for decades. We have longtime clients. We have a very good reputation on the U.S. market. So hopefully this whole tariff situation will land in a more favorable place at some point in time, meaning here a very differentiated position for Canada versus the rest of imports coming from other places of the world, such as the Middle East, India, or Australia, as an example.
And sorry, I just want to ask about the seaborne smelters. Does that mean they're on the water, easy to move, easy to load and ship? Yeah. Okay.
Exactly.
And with everything that has gone on, have you developed some new markets though outside of the U.S., or is that something that doesn't come easily?
Well, it's the way our industry is structured. We already have the three players, which is Rio Tinto, and Alcoa and Alouette, all have a footprint in Europe. So they either produce already from Scandinavian countries to ship to Europe, in Iceland as an example, or as the case is with Alouette, the Setil smelter, they have shareholders who are of European origin who have been taking the metal from Setil and shipping it to Europe for decades now. So we already have a very established footprint in Europe, which means that basically, since we're producing at full capacity, the metal will either go to the US market or go to the European market, all depending on what we call the netback, which is the market that gives you the best return for your shipment.
Okay, we'll have to wrap it up there. We're out of time, but Jean, thank you very much for joining us.
My pleasure.
Jean Simard is President and CEO of the Aluminum Association of Canada. Coming up, we'll take a look at what's moving the markets with Bloomberg Equities reporter Monique Molina. All right, let's see what's moving the markets right now. We're joined by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us. First up, we're talking about Rubrik, a cloud data management and data security company.
Hi, yes, thanks for having me. So Rubrik, they reported earnings, and their earnings beat on revenue, and they raised their 2026 forecast for revenue. So that's why we're really seeing those shares jump today. Analysts saw this as really positive for the company. Like you mentioned, they're in cybersecurity, and they were able to beat this quarter on seeing a lot of growth in the cloud segment, and they're also been able to get some of the customers that are coming from other legacy providers, and that's really been helping to push up their annual recurring revenue. Analysts are also really optimistic that this company is going to be able to capitalize on AI. A number of artificial intelligence companies or other types of companies are looking to use AI agents, which are kind of like bots, for different services online. And customers want to still feel secure, and they see opportunities for Rubrik to be able to capitalize on this and be well positioned in the AI space going forward, which can further their growth even more.
All right. Next up, Bitcoin treasury company Strategy.
Yes, so Strategy, they were the original Bitcoin treasury company, started back in 2020 when they shifted over to buying and holding Bitcoin. They were seeing a lot of growth earlier this year, but their shares have since declined. And as a result, Cantor Fitzgerald cut their price target on the stock by 59% this morning. Cantor pointed to the fact that Bitcoin prices have been declining in recent months. And as a company that basically just buys and holds Bitcoin, obviously when those Bitcoin prices go down, that means that the price of Strategy's holdings also decline. The analysts also note that Strategy's premium has been declining too. So that's the amount it's been able to get as a premium compared to its Bitcoin holdings, which can affect also how it's able to raise capital. And they're also starting to warn the analysts that maybe there's a potential for a crypto winter. If there's going to be a prolonged downturn in Bitcoin or other crypto prices, that's really going to weigh on the shares of Strategy and other crypto companies. And this is also coming at a time when the MSCI index talked about potentially removing companies like Strategy that are just treasury companies, and that could have some near-term impacts on the shares as well.
Okay, next up, MP Materials, rare earths is what it produces, and everybody wants to know what's happening with those rare earths. What's going on with them?
Yeah, so MP Materials, they were upgraded today at Morgan Stanley. They were the company that the U.S. government took a stake in earlier this year that focuses on rare earths, specifically for some magnets. And this is a company that's been able to see a lot of growth, and analysts think that that's going to continue. The majority of rare earths in the world right now come from China, but China has been putting in place certain export restrictions and licensing requirements that have made it harder for people to get those rare earths from China to other countries. And because of that, the US government and other governments around the world are starting to focus more on their domestic supply chain. And that's really where MP Materials comes in, where they're looking to have a domestic kind of integrated supply chain of rare earths and magnets. And they are going to be able to capitalize on some of these these companies that aren't going to be able to, or it's going to become more difficult for them to get it from China. So that's why they're really seeing some of that positive momentum.
Okay, we're just about out of time, but old school coal mining company, is it Ramaco?
Yes, so Ramaco, like you mentioned, they're in coal mining, but they're also seeing growth from rare earths. The company now has a rare earth project, and they're really hoping that that's going to show significant growth. Like we mentioned, this has been an area of focus for many governments and companies around the world, and that's the direction that it's headed. Analysts see new opportunities for this company, saying it could be transformational, but it's still early stages for this. So in the meantime, they're still going to be doing their coal business, which is hoping to see a bit of momentum because of pressures in other parts of the world. But the main focus going forward is going to be on their rare earths as well.
Okay, now, until we have an extra 30 seconds to squeeze in, a Canadian company, New Pacific Metals.
Yes, so New Pacific, they were initiated at BMO today with a positive rating. They are a silver miner that could be one of the largest silver producers in the world. They have a number of mines in Bolivia, and BMO really sees them as being discounted right now. So they see new opportunities for them, especially with backing from some of the larger silver companies as well.
Okay, and we'll leave it there. Have a great weekend, Monique. Bloomberg
Thanks,
Equities. All right, Bloomberg Equities reporter Monique Malima. Coming up, legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. More on his legacy, his incredible legacy, when we come back. Well, legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. This week's Bloomberg Doc dives into how the Oracle of Omaha changed investing forever and what's next for the company he built.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping those Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. Both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer-term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing $100 million, $200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high-growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Incredible man. Coming up next, Market Call. Greg Newman is on the show. He is the Senior Wealth Advisor and Portfolio Manager at the Newman Group Scotia McLeod. He'll be taking your questions on North American equities and dividend stocks. That's all for us for now. Thanks for watching Morning Markets. We'll see you on Monday. Have a great weekend.